Welcome to HYCM Insight with myself, Giles Conklin. Now, the market mood for the session ahead is as follows. Fundamentally, things do look very strong for gold. The Fed are patient. They don't look like raising interest rates until at least the middle of next year. This has caused bond yields to pull back as investors were positioning for a faster Fed policy rate heading into the last FOMC meeting. Inflation remains pressured to the upside, and this is keeping real yields lower, which also helps gold. Now, US dollar is not surging higher, and if it starts moving lower, then that should be a big help for gold. Gold also has some very strong seasonals between now and February of next year. You can see that over the last 25 years, gold has risen 18 times between November the 8th and February the 28th. Average gain 3.89%, largest 21.48%, largest loss 8.57%. So there's never any guarantee that a seasonal pattern repeats itself. However, it is helpful to notice when these strong seasonal patterns are in place, and it's strong physical demand for gold around the Chinese Lunar New Year, which particularly lifts gold at this time. Major trade risks. The main risk to this seasonal pattern would be if there's some very hawkish monetary policy reason for further dollar gains and yield gains around the next FOMC policy meeting in December. Also note the strong seasonals in gold, the strong technicals rather. You can just see that gold is breaking out of this very key trend line on the daily chart. And as long as sort of price stays above that trend line, you would anticipate buyers with a potential retest if we can break the 1830 back up to 1900 around the end of the year, or perhaps even heading into next year. Gold is certainly one market to keep your eye on.